Welcome back to the Deep Dive. It is Thursday, February 5th, 2026. And I want you to just picture the dashboard of your car for a second.
Okay.
Usually, when you're driving along, if something's wrong, you get one light, maybe the check engine light flickers on, or you see the low oil warning.
Right. It's annoying, but manageable.
Exactly. You get annoyed, you take it to the shop, you fix it, and you move on. It's an isolated problem.
Right. That's a normal crisis. It's contained. You treat the specific symptom.
But if you looked at the global dashboard this morning, or, well, if you were brave enough to even look in your portfolio,
Yeah.
it feels like every single light is flashing red at the exact same time.
Every single one.
The brakes are out, the engine is overheating, the GPS just went totally blank, and the steering wheel is locked.
That is uncomfortably accurate. And usually in this line of work, we try to avoid hyperbole. We really do. We try to be the voice of reason.
Sure.
But today, chaos feels like an understatement.
It really does. It feels like the ground is actually shifting under our feet.
It is. Because we aren't dealing with a single point of failure today. We are looking at a convergence, what we're calling the synchronized systemic shock.
And synchronized is the absolute key word there, because normally, we do a deep dive on just a market crash.
Right? One topic.
Or just a diplomatic spat in NATO, or just an oil crisis. But today, we have three distinct crises all slamming into each other at the same time.
And they are feeding off each other. That's the real danger here. First, you have the breakdown of Western defense alliances, what we're calling the sovereignty revolt.
Yeah.
Then, simultaneously, you have the severe liquidity event in financial assets that is just.
Yeah.
It's defying the textbooks.
And then the third one?
And third, and this is maybe the most confusing for people watching the ticker tape, you have a historic dislocation between paper commodities and the actual physical stuff.
It's a lot. I mean, it is a lot. And I know the listeners are feeling it. The volatility is off the charts. The anxiety is palpable. I was reading the comments before we started recording. People are scared.
Of course.
They don't know if they should sell everything, buy gold, or just hide under the bed.
Which is a completely natural reaction. But panic is expensive. It's the most expensive emotion you can have in a market. So the mission for this deep dive is to navigate this shock.
Right.
We aren't just going to read the terrifying headlines back to you. We want to move past that and explain why global institutional trust is eroding so fast, and maybe more importantly, why capital is fleeing to hard assets at a rate we haven't seen in decades.
We need to slow this all down.
Yeah.
We need to pop the hood and see why the wiring is melting. So let's lay out the roadmap for everyone. We're going to hit three main pillars today.
Three pillars that I think really explain the whole picture.
Okay, so first we're going to talk about why Canada and Germany, two of the United States' closest allies, our best friends on the playground, are suddenly rejecting U.S. military tech, specifically the F-35 program.
And that's a huge story that isn't getting enough airtime because everyone is so focused on the stock market. But it's the canary in the coal mine for geopolitics. It really is.
Second, we're going to unpack the violent jiggle in silver prices. And I have to say, when I read that term in the notes, I kind of laughed, but then I looked at the chart and I definitely stopped laughing.
Yeah, it's a jarring term for a jarring move.
And we'll talk about the Shanghai premium and why maybe you shouldn't have a heart attack if you own precious metals right now.
That second point is absolutely crucial. It's the difference between price and value. They are not the same thing today.
And third, we're going to look at the valuation anomaly in mining stocks. Why are these companies priced like they're going out of business when the stuff they dig out of the ground is hitting record highs?
It's one of those rare moments where the market seems to be pricing into completely contradictory realities at the same time. It's fascinating.
Okay, let's unpack this. Let's start with Pillar 1, the sovereignty revolt. This is about defense and data. And honestly, this blew my mind when I was digging into the source reports this week. We have to start with Canada.
Our polite, reliable neighbor to the north.
Exactly. Canada is usually the reliable one. They follow the U.S. lead on almost everything. But right now, Ottawa is facing intense pressure to cancel its purchase of 80 F-35 Lightning II jets. This is supposed to be a done deal.
Oh, it was supposed to be a lock, a total lock. We're talking about a $19 billion deal. The contracts were drawn up. The handshakes were made. I mean, this is supposed to be the backbone of NORAD.
And now, they're looking for the exit door. They're seriously looking at pivoting to Sweden's Saab Gripen. Now, usually when these huge military deals fall through, it's about money, it's over budget, the taxpayers are angry, we can't afford it.
That's the standard playbook, yes.
But the sources are all saying that's not the main driver here. not at all.
No, and that's what makes this so significant. This isn't just a budget dispute. This is about digital sovereignty. And that's a concept we are going to be hearing a lot more about in 2026.
Digital sovereignty. It sounds like a buzzword. Break that down for us. Why does buying an American jet suddenly threaten Canada's sovereignty?
Well, to understand this, you have to understand what the F-35 actually is. We call it a fighter jet, and we picture, Top Gun dogfighting, banking turns, missiles.
All right.
But the F-35 isn't really a plane in that traditional sense. It's a flying supercomputer. It's a massive floating sensor platform that just happens to be wrapped in stealth coating.
Okay, so it's high tech. We get that.
It's incredibly high-tech. But to operate, to actually fight, it relies on something called the mission data files.
Mission data files. What is that? Is that like a fancy map?
Think of it as much, much deeper than a map. It's the threat library. It's a massive, constantly updated database of every known threat signature, every enemy radar frequency, all the operational parameters.
Just give me an example.
Okay, so let's say the jet's sensors pick up a radar signal 100 miles away. The jet has to look at that signal, compare it to the mission data file, and identify it. Is that a commercial airliner? Is that a friendly radar from an ally? Or is that an enemy S-400 missile system that's about to lock onto me?
So without the file, the plane is basically blind.
It's worse than blind. It's confused. It might see the signal, but it doesn't know how to jam it. It doesn't know the specific frequency countermeasures to use. It doesn't know if it should run or fight. The file tells the plane how to survive.
Okay, so you absolutely need the files. Canada buys the jets, they get the files.
Yeah.
So what's the problem?
The problem is who controls the files. And the U.S. Department of Defense manages those files exclusively.
Exclusively?
Exclusively. Canada does not get the source code. They do not get to update the library themselves. They can't add a new threat they've identified on their own.
So wait a minute. If I'm Canada and I buy this $19 billion fleet of jets,
Right.
I don't actually control the software that runs it.
Exactly. You've hit the nail on the head. It creates a single point of failure. If you are a sovereign nation and you are flying the most advanced fighter jet in the world, but you cannot update the threat library yourself, you have a massive problem.
Or let's take it a step further.
Let's get darker. What if the U.S. decides to shut off the data feed?
Can they do that? Can they actually just flip a switch?
Technically, yes. Or they could simply delay an update. Let's say Canada wants to deploy these jets in a region to protect its interests, but the U.S. has a conflicting diplomatic interest there. The U.S. could just say, sorry, we can't update your threat files for that theater right now. We're working on it.
And the jets become useless. They're just very expensive airshow performers.
They don't work independently. You are effectively renting the capability to defend your own airspace from the United States. It's subscription model warfare.
That is a wild realization. I mean, that's like buying a smartphone, say an iPhone. But Apple decides who you can call and when you can use the GPS. And if they don't like where you're driving, they just brick the phone from Cupertino.
That is a perfect analogy. And for a long time, allies were okay with that because the trust was absolute. The assumption was, we are NATO, we are NORAD, we were all on the same team. The U.S. would never, ever brick our phones.
But that trust is clearly eroding.
It's evaporating. Fast. Nations are realizing that buying the jet doesn't mean you own the operation of it. And, Canada isn't the only one waking up to this reality.
But the report mentions Germany is getting cold feet, too.
Yeah.
And if Canada is a problem, Germany is a heavyweight crisis.
A huge crisis. Germany is reportedly reconsidering its commitment to the F-35 as well. Now, just stop and think about the implications of that for a second. If Germany flips,
That domino effect.
it triggers a contagion across NATO. You have the two biggest economic engines in their respective regions, Canada in North America and Germany in Europe, potentially saying, we don't trust the U.S. to hold the keys to our defense anymore.
So it's not just a lost sale. It's not just about Lockheed Martin's stock price.
No, no, no. This threatens the entire interoperability of the alliance. If everyone starts buying Swedish Gripens or French Rafales because they want sovereign control over their own data, the unified NATO front it fractures. And from a simple financial perspective, you are talking about tens of billions in U.S. export revenue just vanishing into thin air.
It really feels like the empire is overplaying its hand.
Yeah.
Trying to control allies so tightly that they just decide to walk away entirely.
It's the classic imperial trap. You squeeze too hard and the sand just slips right through your fingers. And this theme of walking away, of creating bypasses, isn't limited to the military stuff. It's bleeding directly into economic infrastructure too.
Okay, let's connect those dots.
We have this fascinating update on Canada's energy moves.
This connects directly to the sovereignty theme. If you don't trust the U.S. with your defense data, you start looking at your economic reliance, too. Canada has always sent its oil south, right? I mean, we buy basically all of it.
Almost all of it. For decades, they were a captive market. U.S. refiners in the Gulf Coast set the price because Canada had literally nowhere else to send it. They were stuck.
But not anymore.
But now,
Ugh.
Canada is exploring a massive new pipeline project. The goal is to ship 1 million barrels of crude oil per day directly to Asia via their Pacific ports.
And the key here, the really critical part, is that it bypasses the United States entirely.
Completely. They are building a backdoor, a strategic backdoor. Instead of piping it down to Texas, they pipe it west to the coast, put it on a tanker, and it's in Asia in 18 days.
That's a massive shift in efficiency. I mean, that's a game changer for them. But the geopolitical irony here is so rich. I was reading the notes on this, and I actually laughed out loud.
It's unbelievable.
At the exact same time Canada is building this bypass to Asia, what is the U.S. doing with China regarding oil?
This is where you have to laugh or you'll cry. The U.S. is currently, right now, pressuring Beijing to resume buying U.S. crude oil.
Wait, why? I thought we were in a trade war.
We have a domestic glut. We have too much oil in the U.S. right now, partially caused by a flood of Venezuelan imports hitting the market. So the U.S. is literally begging China to take our oil off our hands to prop up domestic prices.
So let me get this straight. We are begging China to buy our oil, which gives China leverage over us.
Yes.
Meanwhile, our closest ally, Canada, is building their own direct line to sell to China, completely bypassing us.
Exactly. We are getting squeezed on both ends. We are handing China leverage while simultaneously losing our leverage over Canada. It's a strategic nightmare.
It seems like the U.S. is losing soft power leverage, like the F-35 data control, and at the same time, we are seeing our hard economic leverage just slip away.
And speaking of leverage,
We have to talk about the Strait of Hormuz, because while we are losing soft power, the hard power risks are just flashing bright red.
this is the hard power component of the systemic shock. While we're all distracted by pipelines and software codes and market crashes, the tension has spiked dramatically in the Gulf. We've had reports that Iran's IRGC seized 2 fuel vessels just in the last 48 hours.
And the rhetoric coming out of there isn't the usual diplomatic saber-rattling. I saw the phrase, place of massacre, in one of the reports.
Yes, former Iranian officials issued a stark warning that the strait could become a place of massacre for the U.S. Navy. They claim their ballistic missiles are on high alert, ready to go.
Now you have to ask, is that just bluster? Or is it a real credible threat?
You know, whether it is bluster or imminent intent almost doesn't matter for the markets. It fundamentally changes the risk calculation for every single barrel of oil moving through that choke point.
How so?
If insurance rates for tankers skyrocket because of the threat of missiles, and they will, the price of energy skyrockets for everyone, everywhere. It's an instant inflation tax on the entire global economy.
So let's synthesize this first section before we move on. We have the U.S. losing control over its closest allies because of this data sovereignty issue with the F-35s.
Right, a soft power failure.
We have those same allies actively building infrastructure to bypass the U.S. economy, the Canadian pipeline.
An economic power failure.
And we have a potential war zone heating up in the most critical energy artery in the world.
A hard power challenge.
Okay.
It creates a picture of an empire that is overstretched and, frankly, undertrusted.
Yep.
The U.S. is trying to maintain control through these kill switches in technology, like the F-35 data, but the result is that allies are just looking for the exit. They're walking away.
And when trust breaks down like that,
When trust breaks down, people and nations start looking for things they can actually hold, things they can control themselves.
which is the absolute perfect transition to our second pillar, Section 2, the silver bifurcation, or as the report calls it, paper versus physical.
And this is the part of the deep dive where we have to ask the listener to just put aside what they think they know about price. Because if you just looked at a chart of silver prices recently, you saw a crash, a big one.
A flash crash, right?
Okay.
I'm looking at the data here. A 22% drop in a day.
Right, a brutal move down.
Now, I have to be honest with you. The analysts in our source material are calling this the violent jiggle.
The violent jiggle. It's a term used by a veteran analyst, Michael Oliver.
Okay, I have to stop you there. A jiggle. I mean, come on. If I'm a listener and I'm holding silver and I watch my portfolio drop 22% in 24 hours, jiggle feels a little insulting.
I get it.
That feels like a disaster.
Yeah.
That feels like I just lost a quarter of my wealth. Why shouldn't I be panicking?
That is a completely fair and rational reaction. Visually on a chart, it looks like an absolute disaster. It looks like the floor fell out. But Michael Oliver is a technician's technician. He looks at structure, not just price.
Okay.
And his argument, which is controversial, I'll grant you, but it is backed by decades of data, is that this drop broke no long-term momentum trends.
Wait, Han, how does a 22% drop not break a trend? That sounds like the definition of a bear market starting.
It sounds like one, but in the context of the massive volatility we are seeing everywhere, Oliver characterizes it as a one-day phenomenon. He believes it was an engineered event designed to do one thing: shake out weak hands.
Weak hands. You mean regular investors who get nervous?
Well, specifically investors who are highly leveraged, people using futures contracts with a lot of borrowed money, investors who have tight stop-loss orders set. When the price dips sharply, their computers automatically sell, which creates a cascade. It drives the price down even further.
A chain reaction.
A chain reaction. But Oliver's point is that the structural demand hasn't changed one bit. Historically, moves like this, these sharp, sudden, violent drops that don't violate the long-term structure, they often precede rapid recoveries. We're talking about snapping back to new highs within a month, sometimes even weeks.
This was a bear trap, a classic fake-out move.
Effectively, yes. A very painful one. But here is where it gets really, really interesting. While the Western paper price, the price you see on your screen in New York, was crashing, the physical reality in the East was doing the exact opposite. This is the historic dislocation we mentioned.
We're talking about the arbitrage between the West and the East, the Shanghai premium.
Correct. While silver was dumping in New York and London, silver on the Shanghai Futures Exchange is trading at a premium of over $20 per ounce above the Western spot price.
Stop and think about that math for a second. $20. That is massive. That's not a rounding error. If silver is, say, $30 here, it's $50 there.
It is huge. It's a signal flare that something is broken.
So my question is the obvious one. Why isn't someone just buying it here and selling it there? That's free money, right? That's arbitrage 101. Why isn't that gap closing?
That is the billion-dollar question. And you're right. Normally, arbitrageurs, big banks, hedge funds, they would close that gap in minutes. They would buy contract A, sell contract B, and pocket the difference risk-free. The fact that they haven't tells us something is fundamentally broken in the logistics or the supply chain.
What does that mean? Broken.
It implies that you can't just get the metal in New York and move it.
So the metal isn't there.
Or it's so tightly held that it can't move. The working theory is that Western banks are liquidating paper silver, that's futures, contracts, derivatives, promises of silver, to suppress the price and cover their positions. They are selling paper tickets.
Yep.
Meanwhile, Eastern buyers, specifically in China, are looking at that artificially cheap Western price and saying, thank you very much, we will take the actual metal.
So the West is selling paper, and the East is buying metal. And the result is a physical shortage.
A severe, acute shortage. We have reports from Dubai, another major physical hub, indicating that silver bars have effectively vanished. Poof, gone. The premiums there are hitting $17 an ounce over spot. You cannot get the metal. You can walk in with a briefcase full of cash and you'll walk out empty-handed.
And it's not just Dubai. The report mentions the COMEX, that's the primary commodities exchange in the U.S.
Right, the belly of the beast. The COMEX saw a massive withdrawal of 3 million ounces in a single day. 3 million. But the most telling statistic, and this is the one that should keep bankers up at night, is this. 100% of settled contracts are now demanding physical delivery.
100%. You mean every single person is saying, give me the bars?
100%. Every single one.
Explain why that matters so much to the average person. I mean, usually traders just settle in cash, right? They don't actually want the product.
99.9% of the time. If you and I bet on the price of silver and you win, I just pay you the dollar difference. You don't actually want 5,000 ounces of silver bullion dumped on your driveway.
No, it's heavy. You have to store it. It's a hassle.
It's a huge hassle. The market is a casino for cash settlement.
But now,
nobody wants the cash. They are saying, no, put the metal on the truck. They don't trust the dollar settlement. They want the actual asset.
there it is again. Trust. It's the exact same theme as the F-35. Nations don't trust the U.S. data. Investors don't trust the U.S. paper price.
Exactly. The entire financial system only works if people are willing to accept the paper promise. When they all stand up at once and demand the physical reality, the system breaks. And when you look at the price targets through that lens, the flash crash looks completely irrelevant.
Let's talk about those targets. Because if this paper manipulation scheme finally breaks, where does silver go?
If we zoom out and look at the logarithmic scale, The really big picture view silver is breaking out of a 50-year range. I mean, think about that. It's been stuck in a channel between roughly $4 and $50 for half a century. It's been caged.
And now the cage door is swinging open.
The comparison analysts are making here is to copper back in 2005. Copper had a similar multi-decade breakout, and it exploded fourfold in value very quickly.
Fourfold.
Fourfold. If silver follows that same structural path, the projected targets aren't $50 or $60. We're looking at structural targets of $300 to $500 per ounce.
300 to 500. From where we are now, that is a life-changing move. But it only happens if the physical shortage forces the paper price to catch up to reality.
It happens when the physical shortage becomes impossible to ignore. When the vaults are empty, the paper price becomes a meaningless number on a screen. And speaking of empty vaults, this brings us right back to sovereignty.
Okay.
We talked about data sovereignty with the Jets. Now we need to talk about custodial sovereignty.
This is the part about Wyoming and Germany.
Yeah.
I love this part of the story because it shows that this isn't just, some tinfoil hat theory. These are actual governments making these moves.
Right. This is state-level policy. The state of Wyoming has moved its reserves to a new state-based vault. They are bypassing federal custodians like J.P. Morgan. They are saying, we don't trust the New York banks to actually have our gold when we need it.
And Germany's doing the exact same thing on a much bigger scale.
On a massive scale. Germany filed a formal request to repatriate 13,350 tons of gold from the U.S. Federal Reserve.
1,350 tons. That is a lot of heavy lifting. Why would they go through all that trouble and expense?
The fear driving this is one word: rehypothecation.
Rehypothecation. That's a jargon word. Let's unpack it for the listener. Make it simple.
It's the valet parking analogy we talked about before. You give the valet your keys. You assume your car is safely parked in spot 4B.
Right.
But what if the valet gave a claim ticket for your car to 5 different people?
As long as only one person comes to get the car at any given time, everything seems fine. The scam holds.
Exactly. It works as long as everyone doesn't show up at the same time demanding their car. Rehypothecation is the banking practice of lending the same asset out multiple times over. The deep fear is that the federal vaults are naked, that there are far more paper claims on gold than there is actual physical gold sitting in the vault.
So Germany and Wyoming are looking at the parking lot, they're counting the number of people holding claim tickets, and they're realizing there aren't enough cars for everyone.
And they are deciding to get their car now, before the rush. They want the metal on their own soil, under their own control.
It's the classic game of musical chairs. The music hasn't stopped playing just yet, but Germany and Wyoming are grabbing a chair now while they still can.
Precisely. They are not waiting for the music to stop.
Okay, so we have the physical metal story, which is incredibly bullish. But there is another layer to this. If silver is potentially going to $300, surely the companies that dig it out of the ground are exploding in value, right? I mean, that would be the logical conclusion.
You would absolutely think so. But that brings us to Section 3, the minor opportunity and the tech meltdown. And this is where the market irrationality just hits its absolute peak.
The valuation gap.
It is an absolute jaw-dropping anomaly. We have metal prices that, despite that recent jiggle, are still historically very high. The average silver price for the quarter is hovering near $100.
$100?
That's double, sometimes triple what it was in previous cycles. These companies should be printing money hand over fist.
But the mining stocks, the share prices.
They are acting like the metal is worthless. Their report mentions the XAU mining index to gold ratio.
And what does that ratio tell us? What's its significance?
It's a simple comparison. It compares the price of the basket of mining stocks to the price of the metal itself. Historically, that ratio averages about 25%.
Okay, so a quarter.
A quarter, right. Right now, it has collapsed to somewhere between 4 and 8%.
Wow. So relative to the price of the thing they sell, the companies are valued at a tiny fraction of their historical norm.
They are effectively priced for bankruptcy. The market is pricing these companies as if they are about to go out of business. Yet this month, in February, they are about to report massive, record-breaking earnings growth.
Because the metal price is so high.
Exactly. You have companies that are selling a product for $100 that cost them, say, $20 to pull out of the ground. The margins are insane. The free cash flow is going to be undeniable when those reports hit.
So why the disconnect? Why is Wall Street ignoring this? Is it just stupidity?
It's a lag. Institutional money is slow. It's like turning an aircraft carrier. They are still chasing the old narrative. They are still chasing tech stocks. But this disconnect, this gap, represents a generational buying opportunity. It's a coiled spring, Eventually, the earnings reports come out, the cash hits the balance sheet, and the math simply forces the stock price up.
And while the miners are priced for death, the so-called soft assets, tech and crypto, are having a meltdown of their own.
It's the perfect flip side of the coin. While capital is hesitant to enter the hard asset space, it is violently fleeing the soft asset space. We are seeing a software meltdown.
A meltdown.
Hedge funds have built up a $24 billion short position against software stocks.
$24 billion. Against SaaS software as a service. That's a massive bet against the entire sector. Why the hate for SaaS all of a sudden? It's been the darling of Wall Street for a decade.
It's the double-edged sword of AI. Everyone thought AI would be a huge boost for tech stocks. And for some, maybe it is. But for most SaaS companies, AI is terrifying.
Why?
Think about it. If an AI can write code, build a website, manage a customer database, or create marketing copy for almost zero marginal cost, why am I paying Salesforce or Adobe a huge monthly subscription fee?
It commoditizes their product. It turns their proprietary magic into a cheap commodity that anyone can access.
Exactly. The moat, their competitive advantage, is gone. It's evaporating. And at the exact same time, we have to talk about Bitcoin.
Yeah, Bitcoin. Digital gold. It's supposed to be the hedge against all this chaos, right? When the system shakes, Bitcoin is supposed to rally. That's been the sales pitch for years.
That was the narrative. That was
Yeah.
the hope. But in this specific shock, it has failed as a non-correlated hedge. It's failed the test. It is trading in lockstep with other risk assets like the NASDAQ. It dropped to around $67,000.
Which is still a high number historically, but in the context of what it's supposed to do, protect you from a systemic crash, it's failing. Why?
The reports point to two major things: quantum risk and this same AI commoditization theme.
Okay, I hear quantum risk thrown around a lot, but it usually sounds like science fiction. Is this a real threat now, or is it just FUD, fear, uncertainty, and doubt?
I think it's becoming very real, very fast in the minds of institutional investors. Think of Bitcoin security like a safe. The combination to that safe is a math problem that is so incredibly hard, a normal supercomputer would take millions of years to solve it. That's what makes your wallet safe.
Right, the encryption.
Exactly. But a quantum computer doesn't work like a normal computer. It can solve those specific types of math problems exponentially faster. The fear, and we are seeing this priced in now, is that as quantum computing power explodes in 2026, the legacy encryption that protects Bitcoin might be crackable.
So if you have a powerful enough quantum computer, you could effectively pick the lock on the blockchain.
Theoretically, yes, or at least the market fears you could. And in a market that is driven by fear, that narrative alone is enough to kill the momentum. So you have AI killing the perceived value of software code, and you have quantum killing the trust in cryptographic code.
Which leaves investors running to rocks.
Rocks. And oil, things that are physical. You can't quantum hack a bar of gold. You can't use AI to generate a barrel of oil. In a world of digital chaos, the physical becomes the ultimate premium asset.
So we have hard assets becoming the only real refuge, while the future tech assets, SaaS, crypto, even the F-35s, are all facing these existential crises of trust and value.
That is the perfect summary. It's a great rotation. A rotation from the virtual back to the real.
So what does this all look like for the broader economy? We need to zoom out. Let's look at Section 4, the macro outlook and governance risks. The report uses the term the global neutral. What does that mean?
The global neutral describes a market environment where equities basically stagnate, they go nowhere, but commodities roar. We're looking at the S&P 500 in what appears to be a major topping process.
So the big bull run in stocks is over.
The easy money is definitely gone. The report suggests we might see one last teaser rally, maybe up to 7,100 on the S&P.
Teaser rally, just enough to suck everyone back in before the real rug pull.
Exactly. It's to clear the negative tariff narrative, get some positive headlines, but the rollover is coming. And the main catalyst for that is the U.S. dollar.
The dollar index, the DXY, has been the wrecking ball of the global economy for years. A strong dollar hurts everyone else. But that's changing.
It is breaking down. The U.S. dollar index has broken its key annual momentum trends. The projection is for it to challenge level 70.
Wow. It was up near 97 not that long ago. A drop to 70 is...
Well, that's a collapse. It's a massive devaluation. And you have to understand the mechanic here. Commodities are priced in dollars. If the dollar gets cheaper, it takes more of those cheaper dollars to buy a barrel of oil or an ounce of gold.
So a weak dollar is bullish for commodities.
It's a massive tailwind. A huge one. It's a tailwind for emerging markets, places like Brazil, and critically, for all commodities. It just adds fuel to the fire we discussed in Section 2 with silver.
But a crashing dollar usually means inflation at home, right?
Well,
Everything you import gets more expensive.
and that leads us directly to the stagflationary trap.
The worst of all worlds, stagnant growth, high inflation.
Look at the labor market data. The JOLTS report, that's job openings, it shows openings crashing to a 5-year low.
So the jobs are vanishing.
The jobs are vanishing. That's the stagnation part of the equation. The economy's slowing down fast. But then look at prices. Tariffs are keeping the prices high on imported goods.
That's the inflation part.
Exactly. So you have a slowing economy, disappearing jobs, but the prices at the store stay stubbornly high, and the Fed is trapped. They're completely boxed in.
Explain the trap. Why can't they just fix it with their tools?
Because they only have two tools, really. They can print money to stimulate, or they can raise interest rates to cool things down. If they print money to stimulate the economy and create jobs,
They make inflation worse.
way worse, which they can't do. But if they raise rates to fight the inflation,
They crush the economy further and destroy even more jobs.
so they are checkmated, paralyzed. They can't make a move without breaking something important.
And just to add a cherry on top of this whole disaster Sunday, we have a governance scandal, the pay-to-play story.
Right. This adds what we call a political risk premium to U.S. assets. International investors look at this stuff and they get very nervous about parking their capital here.
So what are the details? Because in this political climate, everything is a scandal. Is this a real issue?
The report details a $500 million stake in a Trump-linked company that was sold to a UAE entity.
Okay, a big money deal. That happens all the time.
But the timing is the issue. This sale was immediately followed by the approval of restricted AI chip exports to that same country, the UAE.
Ah. So money changes hands, and suddenly the export restrictions on critical technology are lifted.
That is the implication, the quid pro quo. Now, whether it's provably true or not, almost it doesn't matter to the market. The perception of it raises serious questions about U.S. governance. It reinforces that erosion of trust we talked about in Section 1.
It brings everything full circle. If U.S. foreign policy is for sale, or if U.S. defense data is unreliable, or if U.S. bank vaults might be empty, why would you keep your capital here?
Exactly. Why would you play the game if you think the House is rigging the deck against you?
So let's wrap this all up. We've covered a massive amount of ground. We've gone from fighter jets in Canada to silver vaults in Shanghai to political deals in the UAE. Let's try to synthesize this for the listener. What is the one big thing they need to take away from all this?
If we tie the three pillars together, the message is crystal clear. It's a story of rejection, a great rejection. Nations don't trust U.S. military tech. That's the data sovereignty revolt.
Right.
Investors don't trust paper prices. That's the fiscal sovereignty revolt. And now, states and other countries don't trust the federal vaults. That's the custodial sovereignty revolt.
It's a fundamental movement from trust-based systems to verification-based systems.
Exactly. In the old world, the world of 10 years ago, you trusted the paper promise. You trusted the alliance. You trusted the bank. You didn't ask questions. In the world of 2026, you don't trust. You verify. You want the physical metal in your own hand. You want sovereign control of your own data. You want to see the car in the parking spot with your own eyes.
So the violent jiggle in the market, that scary 22% drop in silver, is just noise.
It's noise, and it's noise designed to scare you out of the only asset class that actually holds real, tangible value in a low-trust world. The physical asset is the anchor in the storm.
That is a powerful takeaway. The world is changing, and the rules of money and power are changing right along with it.
They are. And if you don't change your strategy to match this new reality, you're going to get left behind holding a handful of paper promises that nobody wants to honor.
I want to leave the listener with a final thought, a final question to chew on. We talked about Germany pulling its gold. We talked about Canada building new pipelines to bypass us. We talked about Wyoming building its own vaults. These are huge players' governments, major economies making defensive moves to protect themselves.
They see what's coming.
So here's the question for you. If Germany and Wyoming are pulling their wealth out of the system to hold it themselves, and Canada is rewiring its trade routes to bypass the U.S., are your assets positioned for the world that exists today, or are they still positioned for the one that existed 10 years ago?
That is the question everyone needs to answer for themselves, probably before the markets open tomorrow.
Thanks for listening to The Deep Dive. We'll be watching the charts, we'll be watching the headlines, and we'll be back to help you make sense of the chaos. We'll see you next time.
Stay safe out there.